Hello and welcome to Simply Tax. It's March 30th, 2020, and we're back with the second episode of our COVID-19 response series to help you cut through the static of the headlines swirling in both the tax and business world during this unprecedented, fast-moving, and challenging time. I think an important part of being a great tax and business advisor, particularly when there's a need to unpack new tax law, is knowing your technical areas of strength and flanking those areas that you're not so strong in with others that are. Getting into the weeds on the complexities of payroll-related issues is not the end of the pool that I'm comfortable swimming in alone. So today you'll hear from my go-to guy and life preserver, Ryan Peterson, to help us all navigate these often choppier waters than I think some sometimes think, to break down and offer practical insights on the payroll-related relief provisions in the second and third federal relief packages that were recently enacted in response to COVID-19. Be sure to stay tuned to the end of the episode today to find out where you can learn more about Ryan and find the resources that we mentioned. And one last thing, we're putting together a Q&A episode to answer your questions on the tax and accounting related developments of the coronavirus response. Drop us an email at simplytax@bkd.com, or better yet, pause the episode, break out your smartphone, record a voice note, and send it to us for a chance to hear your voice on the Simply Tax podcast. All right, let's dig in with the payroll-related relief that's now available to both employees and employers with Ryan.
My name is Ryan Peterson, and I'm a director in BKD's Accounting Outsourcing Services Group. And I spent the better part of my career helping the small to mid-sized organization with accounting and payroll needs.
It's an interesting time for that, right? Because I know there's so much with the relief packages now that we've had the three that are enacted and part of the law that are, have provisions that are driven to get money into people's pockets, and payroll is a way to do that, both on the employer side and employee side, obviously. But could you talk a little bit about what we've been seeing and kind of what some of those developments are, and I guess really ultimately what all this comes down to, right, is how does it help people right now in this challenging time that we're in?
I think what's been really interesting is I think we've seen years of payroll tax considerations that have just unfolded in the course of the last week here. We essentially had two pieces of legislation that have really had a profound impact on payroll, an employer that's seeking relief for payroll provisions under the Act. And so, about a week ago, we had the Families First Employer Coronavirus Response Act. And so, that act was a little bit unique. It was very employee specific. It dealt with paid sick leave and emergency family medical leave, but there was a very payroll specific component to it. And so, what was really interesting about that act is that for organizations of a certain size, it basically required employers to compensate employees for certain types of leave. And so in order to help subsidize that, there actually was an offsetting payroll tax credit for that leave. And so we really saw the first payroll-specific application for that, depending on the types of leave that were going to be paid.
And I think that's probably a great place to start, is that depending on what types of leave are going to be paid, and understanding that. What have you been seeing when you were helping people to understand these things? Are there any hangups, or again, just if you were to kind of give them some guideposts around that, what are some things to watch for there?
Yeah, so I think it's first important, before we get to the credit, to understand the types of leave. Essentially, there were two types of leave provided for in this act, and the first was emergency paid sick leave, and this is probably the provision that organizations are most familiar with. And so, effectively, it required organizations of less than 500 employees to basically compensate employees for up to 10 days or 80 hours of paid sick leave if they were impacted by COVID-19. And so there's a number of specific criteria, I think, that factor into this, whether an individual is sick themselves or is quarantining associated with a medical opinion. And so effectively, what this piece of leave entitled employees to was basically 10 days of 100% paid leave. In addition to kind of this paid sick leave, there was a secondary component to it where employee-specific courses of leave associated due to the virus, for if an employee was impacted that had a son or daughter that had been impacted by childcare closures, and so effectively unable to come to work because of a school closure or a childcare facility, they were actually entitled to 2/3 of normal compensation for the same 10 days or 80 hours. So both of those pieces kind of factored into this emergency paid sick leave provision of the bill. On top of the emergency paid sick leave, there was an expansion of family medical leave. And so really what that allowed is that kind of for those same last category of employees that was unable to come to work due to school closures or childcare closures, it actually entitled up to an additional 10 weeks of compensation, 2/3 of what the regular rate of pay was. And there's certain caps and limitations that apply to all of this compensation that potentially could be required to be paid. From an employer perspective, it's a requirement for employers to pay, effective as of April 1st of a certain size. But there also is an offsetting payroll tax credit for those pieces. And so employers were able to take essentially a credit against their employment taxes for the leave that they were paying. And so the mechanics of that were a little bit interesting. And there's been some additional guidance that's come out in the week since that was released. But it allowed employers to take credits against Social Security tax in order to basically refund leave to them.
Yeah, it's a lot more complicated than it would seem, even, right? Because I think there's a lot of discussions around people maybe have this general sense of awareness. I'm going to go ahead and interrupt myself here and also agree with myself in that there really are a lot of nuances and definitions to work through when implementing both the employee and the employer side of the provisions that Ryan was just discussing. And there have been no shortage of questions as a result. BKD's National Tax Team recently held a webinar on March 26, 2020, that we've included a link to the archive of in the show notes of this episode. And I called up Julia Dengel and Yelena Bosovik, both of whom have made appearances on the podcast before and presented as part of the webinar, to share answers to some of those questions and the finer points in this area. Here's Yelena.
This bill mandates that employers with fewer than 500 employees provide up to 12 weeks of paid leave for employees who are unable to work due to COVID-19. And we'll get into all the details, but I think the question we've been asked most often is the effective date. And as of now, that is uncertain because the act itself just says this act will be effective within 15 days of enactment. As of now, all we have is a FAQ page on the Department of Labor website, which says that the effective date is April 1st, 2020, and applies to leave taken between April 1st, 2020 and December 31st, 2020. However, that's not official guidance, but per the same FAQ, we're expecting regulations from the Department of Labor to come out in April. And hopefully that will have an effective date. But so as of now, we're just going to go with April 1st, 2020. But that is an open point at the time of this recording.
Yep, it's me again interrupting here. I know, how rude of me, right? So Yelena and I spoke on Friday, March 27th, after her webinar, and in a true demonstration of how fast-moving this stuff is, the IRS has since released Notice 2020-21, which aligns with the Department of Labor's determination of the effective date.
The IRS did release a notice stating that the IRS and Department of Labor will issue a temporary non-compliance or non-enforcement policy that provides that for 30 days, labor will focus on compliance assistance as long as an employer shows a good faith effort to comply with the policy. There won't be any enforcement action. So that should give people some relief to try to figure out how to implement this in their companies if they are subject to this. And the employer subject to this, again, is fewer than 500 employees. It also could potentially exempt small businesses with fewer than 50 employees and then healthcare providers, but those are not statutory exemptions quite yet. Again, we're waiting for the Department of Labor to issue regulations with those exemptions because they do have the authority to do so under the Act. The two types of paid leave under this Act is paid sick leave and then an expanded Family and Medical Leave Act that basically adds another category of people who are eligible to take FMLA leave. So I'll start with FMLA leave. The rules are all the same as regular FMLA leave, except they add a category of people who are unable to work or telework because a child's school or daycare was closed, and that qualifies you for up to 12 weeks of paid leave. But the first 2 weeks are unpaid. And the way that works is there's another provision in the Act, the paid sick leave provision, and that gives you 2 weeks of paid sick leave. So if you put these two provisions next to each other, you can essentially use the first 2 weeks of paid sick leave, and then you have 10 weeks of expanded FMLA leave. The difference between those two is paid sick leave applies to a broader category in that you can take this paid sick leave for one of 6 reasons. And those 6 reasons are if an employee is unable to work or telework due to federal, state, or local quarantine orders, or a healthcare provider has advised an employee to self quarantine because of COVID-19, the employee is experiencing symptoms of COVID-19 and is seeking medical diagnosis. Number 4 is employee is a caregiver for an individual, not limited to a family member, and subject to a quarantine order, or someone who's been advised to self-quarantine by a healthcare provider. Number 5 is employee who must care for an employee's child whose school or daycare has been closed, or if the childcare provider is unavailable due to COVID-19. So that's that same reason as FMLA. So there's that crossover between the two types of provisions. And then 6 is kind of a catch-all that says an employee has a substantially similar condition yet to be specified by the Secretary of Health and Human Services. So that's kind of a catch-all in case anything else comes up during this outbreak that would qualify for this paid sick leave. If you are in one of the three, which is you're quarantined because you're taking care of yourself, or you're sick, or you're seeking diagnosis, you're eligible to take up to 80 hours of paid leave if you're a full-time employee, and you get 100% of your wages capped at 511 per day and 5110 total for each employee. And then under FMLA, that's up to 2/3 of your pay, and that's capped at $200 per day, and then 10,000 for in the aggregate under FMLA. And then under paid sick leave, it's the same thing, 2/3, but capped at also 10,000. So again, it's complicated because these provisions are two different provisions for sick paid leave, but they kind of play off of each other. So you can technically take that leave together or separately, and the type of employees who qualify for that leave are different for the two categories. But the good thing about this is if you are mandated by law to provide this leave, the government is subsidizing it dollar for dollar. And so Julia can actually tell you more about the credits portion of it.
Yeah, thanks, Yelena. So, like you mentioned, to help subsidize the cost that employers will have to burden to actually provide these paid sick and paid family leave benefits, the Families First Act actually created a series of refundable payroll tax credits that employers can claim on a quarterly basis, and it's going to be on wages paid, those qualifying wages paid through 2020. In addition to those amounts paid related to the sick or family leave, employers will also receive a credit for the amount of qualified health plan expenses and their portion of Medicare tax that's allocable to that qualified leave that they pay. An important note there is that any sick or family leave wages paid under the Act are completely exempt from the employer's portion of Social Security tax, which that's another common question that we've been getting. Self-employed taxpayers, they're also eligible for a refundable credit against income tax paid on earnings subject to self-employment tax. Actually, during our webinar that we presented, March 26th, we covered two examples that kind of walk through how these credits work. And if you haven't tuned into that webinar, the archive is available. So we recommend you go out and listen to that and kind of tune into those specific examples that we walked through. But for today, we're going to talk about more from a high level of how those credits work. So, and Yelena actually walked through pretty well how the caps and the limitations work. And so, just as a reminder, on the flip side for the employer, since those paid leave benefits are fully subsidized, the credit amount would pretty much mirror the amount of paid leave that goes to employees. The only difference is in the situations where the paid leave isn't related to the employee taking care of themselves, where the cap is that 2/3 of paid leave that's required to be paid. The employer, their credit is also subject to that cap. So the employer, out of the goodness of their heart, they can go ahead and pay more than that 2/3 of the employee's wage. However, they're only going to be subsidized through a payroll tax credit up to that 2/3 amount. So that's something to keep in mind there. And it also kind of goes into another common question that we've been getting is what if, as an employer, you have more than 500 employees? So technically, you're not subject to these paid leave provisions. So, as an employer, what if you're not subject to these paid leave provisions, but you decide to go ahead and offer paid leave to your employees? Are you going to be able to get a credit for that? And the answer is no. So, it's only if you're required to make these payments under the Act that you're going to be able to get a corresponding payroll tax credit for those wages that you pay.
All right, let's get back to my conversation with Ryan and pick up with further relief that's been provided after the Families First Coronavirus Response Act. Obviously, since then, we've had the third relief package, the CARES Act, go through the process and come into law. Could you talk a little bit about maybe some of the credits that are available there, maybe a little bit broader perhaps than the Families First?
Yeah, absolutely. So I think with the Families First Act, in my opinion, the act was very employee focused on compensating employees for leave that they needed to take associated with their own care or care of someone else. And so with the CARES Act that was signed just recently, it's a much more employer facing act, in my opinion. And so there were really two specific payroll pieces to the CARES Act that I think were really important for organizations to understand. And the first is what's called the Employee Retention Credit. And effectively, what the employee retention credit is, it's a potential payroll tax credit on qualifying wages paid between March 12th, 2020 and the end of this year, so December 31st, 2020. And again, it's a credit against employers' Social Security tax for qualifying wages paid. And so there's some details embedded in what really constitutes qualifying wages. But this credit potentially is as much as 50% of up to $10,000 in wages per employee. So this particular credit could be as much of a credit as $5,000 per employee as we move forward here. So there could be some really nice relief there. What's really interesting about this employee retention credit is that there's some specific qualifications that apply, but it also potentially there's an incentive there for larger employers that may have been effectively kind of exempted from this Families First payroll tax credit because they were too large. And so there are provisions associated with this employee retention credit that may open up some opportunities to larger organizations.
I guess maybe kind of unpack it a bit of certain types of wages and how that's determined and who qualifies for it. So could you dig in a little bit there, and then perhaps kind of how this fits into the overall maybe decisions that people need to make right now relative to their people? Because obviously, even as the name suggests, right, it's aimed at helping you retain employees.
There are some very specific eligibility requirements that we can talk through. And there's also some consideration given. Obviously, the CARES Act included a number of different provisions. And with some of these provisions, it's really an either or type scenario, that it's not necessarily both as it pertains to how these provisions interplay with one another. And so I think the first thing to understand is what employers are eligible for this payroll tax credit. And so really, I think there's really two criteria associated with who's eligible. And the first is that an employer that is operating a trade or business in calendar year 2020. So that's pretty specific, I think, pretty understandable. The second piece, which gets in a little bit greater detail, is that the operation of that trade or business for an organization has to have been fully or partially suspended due to a governmental order that's limited commerce, travel, or group meetings associated with COVID-19. Additionally, there's also a kind of a secondary provision that says if they don't meet that test, they may be eligible if they are receiving gross receipts for a calendar quarter that are less than 50% of the gross receipts that they received during the same calendar quarter in the prior year. So there's kind of two very specific criteria there. One, it's really, the employer has to be in business, and two, they effectively have to have experienced some sort of downturn associated with COVID-19. And so we get a little more into the details, I think, is in terms of determining, well, what wages qualify, because those two definitions alone don't really address employer size. And so when we look at qualifying wages, we kind of said, well, qualifying wages are capped at 10,000 an employee, but there's some underlying criteria there based on employer size. And so I think that's really important for organizations to understand. If an organization has more than 100 employees, qualifying wages only include wages where an employee is unable to provide service to an employer based on one of those two effective economic hardships that we talked about before, where they have to fully or partially suspend operations, or they have gross receipts that are less than 50% of what they were previously. And so that's a pretty specific distinction, because we're talking about employees not being able to provide service. When we deal with smaller employers, those that are less than 100 employees, qualifying wages are calculated based on whether or not the employee is able or unable to provide services. So I think that's a really important distinction to understand, because for organizations with less than 100 employees, there's a much greater applicability to this credit because the employees can be currently providing services to that employer. One thing that I might add associated with this, which is a little bit different, I think, than what we saw in the Families First Act, is when organizations are evaluating this 100 employee threshold, it's important to keep in mind that the controlled group rules do apply in this case. And so it's important to get into the details because a controlled group of corporations could count as a single employer for purposes of evaluating that 100 employee threshold.
There's a lot of questions I'm sure that are starting to crop up. I know that you and I, just in interactions, we've seen and heard a lot of them. I mean, a lot of them starting to get into, okay, well, we have this thing. How do we actually put it into practice, and how do we actually benefit from it? And some of the definitional type things are coming into play. So, could you speak to some of the common questions you're getting there? Maybe the areas that people are having questions, and maybe your take on how to approach some of those, because it's so young, it's so fresh, the ink's still drying, and we need to get some guidance as often as the case on how to actually implement these things.
Yeah, and I think there's a few pieces to this. Obviously, there's a lot here. To your point, the ink really isn't dry yet, and so there's going to be some additional guidance forthcoming. And I think we all should look towards new additional guidance for further clarification on really the principles of the act. But I think there's a couple of things that organizations should be doing right now. Obviously, this was a very, very large act with a number of provisions that expand beyond payroll tax incentives, and so I think it's important for organizations to really evaluate their alternatives to determine, are they going to be eligible for this particular credit? And does it align with their objectives for the short and long term? I think what's interesting about this particular credit is that, there's been a lot of talk about these paycheck protection loans that also appear within the CARES Act. What's really interesting is that organizations don't qualify for this particular credit if they receive a loan under that provision of the act. And so I think it's important to be aware of everything that's going on. Likewise, we just talked about payroll tax credits associated with paid sick leave and family medical leave. And I think there really can't be a double counting of wages for purposes of the credit. And so there's some kind of nuances there that I think it's really important for organizations to understand in determining what makes the most sense for them. I think it starts with a simple evaluation. I think organizations really need to look at their overall compensation package and determine what exactly are they paying employees for right now. Are they compensating them for medical leave, or will they be compensating them for medical leave and family medical leave after April 1st? And so I think tracking is a really critical component to this, to know what wages are being paid for what types of compensation. Beyond that, I think it's important to evaluate their payroll processing systems, whether they process internally or utilize the services of a third-party payroll processor, because much of the implementation of these credits is really going to heavily depend on the systems updates and on the capabilities of that particular system. And so I think it's important to get the opinions and to get the guidance of all service providers, whether it be accounting, payroll processors, employment attorneys, to make sure that they're doing the right things in terms of the compensation that they're tracking and how they're applying that. In addition to that, I think it's really important just to wait for some additional guidance. Clearly, there's a lot to this, to payroll tax credits. And so other items that have been discussed are things along the lines of receiving an advance payment of the credit. There is supposed to be a mechanism for doing that, and the secretary is supposed to release some additional guidance around that provision, as well as ways how that credit is going to be reconciled on quarterly returns, whether any of the credits need to be recaptured, and how do you deal with unusual situations. And one unusual situation that I think a lot of organizations are dealing with is they compensate employees through a professional employer organization, or a PEO. And so they've kind of earmarked a section of the act that, there's going to be some additional guidance forthcoming there in order to help those clients of PEOs and PEOs themselves kind of be able to track and navigate this credit. So I think it's really important for organizations really to be vigilant, to be aware of what's out there, and to work with their service providers as they evaluate different credits and different means of actually applying those credits to compensation that they're paying.
I guess with that, again, as you kind of use that team approach, which is just so important, I think, right? Just bringing all the resources that you have to kind of have a team of advisors to get you to where you need to be on this. But there's perhaps also been some misconceptions just because of the way it's developed, and maybe also because you're kind of almost fitting pieces together of different relief packages and understanding how they relate. And even within the CARES Act, like you said, there's provisions that if you take advantage of one, might mean that you're not taking advantage of another. What confusion are you hearing from people, or even, and I hate to say it, but misconceptions or misunderstandings are you commonly hearing at this point in time?
There's a few that are out there. I think as we look to kind of the provisions of the Families First Act, I think there's some misconception around the effective dates. The Department of Labor has released guidance that has said that the effective date is April 1st for paid leave. And so there may have been leave that's been paid leading up to April 1st. And so I think it's going to be important for organizations really to follow the latest guidance. And because we are dealing with different effective dates. The CARES Act is obviously very, very new, just having been signed on the 27th. And so there's going to be some additional guidance that's released around that related to effective dates and how to track things. While the acts themselves do provide for either some non-enforcement provisions or some guidance on how to act in the interim, I think it's important to follow what's out there because it's really, really difficult to determine what's going to apply and how exactly the mechanics of that are going to apply. I would say that a second consideration here really would just be can I take advantage of multiple provisions of these acts? And the quick answer is yes. Organizations may be able to take advantage of different sections of the acts, but there are certain restrictions. And so I think it's really important when evaluating alternatives to make sure that you're working with your service providers to make sure that you're selecting the options that are going to make the most sense and not effectively not put the organization in a position where they're relying on one set of the act when perhaps another would be more beneficial to that organization's goals. Finally, I think there's really, one of the big misconceptions as we look is to look at the types of leave or the types of wages that are being paid to individual employees. I think we've heard a lot in the days leading up to the signing of the CARES Act in terms of organizations interpreting what they view as paid leave. And so paid leave is very, very specific. The criteria of the Families First Act are very specific. They outline 6 conditions in which paid sick leave or emergency family medical leave may apply. And we've heard a lot of interpretations of that really don't fall within those 6 criteria. And so I think it's really important to be aware of what those criteria are so that we're all applying the guidance consistently and appropriately given the circumstances.
You want to balance the speed at which we want to move forward with all of this, because obviously there's this urgent need in this kind of time of uncertainty and the challenges that so many businesses are faced with. And obviously that's the reason why we saw the legislation and we saw, why the credit's there in the first place. But we don't want to be so hasty as to, not implement it properly too. So it's kind of this difficult juggling act for people kind of looking at this holistically, and kind of how it fits into the fabric of what else is on business owners' minds right now and those that serve them. What else would you maybe add to the conversation that maybe we haven't talked about so far?
Yeah, so I think that there was within the CARES Act, I think there was a kind of an additional provision that may benefit some organizations, and so I think it's important to talk about that. It's probably not as complicated as the employee retention credit, but the act did also outline a provision for a deferral of basically employer paid payroll taxes. And so effectively, really what this meant is that from the date of the act, so March 27th, it allows for a deferral of employment taxes. And so predominantly that would be just Social Security tax under the code. And so effectively what that allows for, it allows for 100% deferral of that particular tax from the date of enactment through the end of 2020, so through December 31st. And so with 50% of that applicable tax being due to be paid by December 31st, 2021, and another 50% due to be paid by December 31st, 2022. And so that can provide potentially some additional cash flow relief. I would say that, again, there are some counteracting provisions there. If a particular organization has any amount of loan forgiveness under the expanded paycheck protection loans, this provision would not apply to that organization. So, and we're awaiting some additional guidance from the Secretary of the Treasury on this as well to really help with the mechanics of how this is reported, how it's tracked, how it's accounted for, because I think this could also provide some necessary cash flow relief to organizations as they navigate the next few weeks and months here to be able to defer a portion of their employment tax obligations.
We're talking about potentially some very big dollars there. And again, I assume kind of your advice earlier on the other pieces of, like with the credits and kind of waiting for some of the the guidance and how to implement it probably kind of comes into play here too, right? And having those conversations and figuring out what it's going to actually mean and talk to the payroll provider and so forth.
Yeah, I would agree. It really is a holistic effort. I mean, organizations are going to need to work with their advisors, their payroll processors to determine exactly how they're going to set up and track this information, as well as how they're going to reconcile it on the back end. So there's a lot of communication that's going to need to take place in the coming days to effectively kind of facilitate the pieces of this legislation that organizations are looking to take advantage of. And so the best advice that we have for our clients that we work with is really to make sure they're getting input from all of the right sources. And so, as we talked about before, that's going to include your accountants and your advisors, your internal management team, employment attorneys, payroll processors. It really is a combined and holistic effort in terms of making sure that all of the proper considerations are made prior to trying to take advantage of some of these incentives in the short term and risking kind of a difficult cleanup process on the back end.
So many moving parts to this, and so yeah, they're kind of unfortunately dire times, and for some businesses, but this is some welcome relief that's available, and so you gotta work through it and add it to the list of things to think about. So, any closing thoughts or words of advice for those that are kind of trudging through this right now?
Best advice is just stay in constant communication with your service providers and really monitor what's out there right now. I think we do anticipate additional guidance and additional regulations from various different agencies, whether it be the Secretary of the Treasury, the Department of Labor. I think there's going to be much more that's going to be released in the coming days and weeks. And so I think it's really important to stay on top of what that is and specifically what it means. And so us as advisors, as well as the entire community, are going to do our best to keep everyone informed. But I do think it's just very important just to constantly be aware of what's out there and how any proposed changes may have an impact.
Fast moving time for sure. And then as a result of that means there's going to be some fast moving shifts, developments, additional guidance. So, Ryan, as always, whenever I have a conversation with you, I feel like I learned something and I've always very much appreciated it. So thank you for carving out some time in this busy time between all the phone calls that I know that you've been fielding, the emails you've been fielding on the topic, and we'll include your contact information, all that kind of good stuff, so people can maybe add to that list if you don't mind. But yeah, thank you again for your time and your insights. You can learn more about Ryan in the show notes of this episode, which are available at bkd.com/simplytax, which is where you'll also get links to the resources that we mentioned during the episode. You can also find information on the latest important tax and accounting changes and developments related to the response to the novel coronavirus at bkd.com/COVID-19-resource-center. We'll be back in your feed real soon with the next episode of our COVID-19 response series, where we'll take a close look at the ins and the outs of the changes to and the new SBA loan programs that Ryan mentioned during our discussion. I'm Damien Martin. Stay safe and sanitized, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.